Okay, so we'll continue with our discussion. This time, our topic would be on cost of capital. Uh, Cost of capital would be one of the more important topics for finance, mainly because it integrates a lot of other topics, including your previous discussions on risk and returns, the computation of your required rates of return, the valuation of your stocks, the valuation of your bonds, and the cost of capital, which would be measured through the use of your weighted average cost of capital, or also known as your WACC, is used in several subsequent topics involving decision making. Normally, the WACC is used as the hurdle rate in determining whether a particular action is to be undertaken or not. So, for me, this topic is very important because again, it integrates a lot of the other topics, and it will be used in subsequent topics as well. So a big portion of your part two in the CMA exam may involve your cost of capital. So let's start. The first practice question here is number 81. Which of the following is not considered a capital component for the purpose of calculating the weighted average cost of capital? So when we're talking about capital, we're talking about your sources of financing. So we're talking about long-term liabilities and your equity. So from the choices given here, obviously, long-term debt is a component of your WACC. The common stock is also a component of your WACC, and your preferred stock is also a component of your WACC. So out of the choices, accounts payable and accruals, which are to be classified as current liabilities, will not form part of your WACC because again, this is a this does not involve financing of your business activities, more on your operating activities only. So the answer for number 81 is Charlie. 82, for a typical firm which with a given capital structure, which of the following is correct? All the rates are after tax. You'll notice a common theme here, class. You'll be tested. No, it's important for you to remember that in computing for your WACC, the individual components must be after tax already. And there will be a lot of questions revolving around the concept in which it is the cost of debt that will benefit from the application of taxes, because the cost of using debt will not be uh, felt by the company in its entirety, because even though it will have to pay interest for using debt financing, it will enjoy tax relief because the interest expense from your debt financing may reduce your will reduce your income tax expenses. So the net effect there would be that the cost of your borrowings, your debt financing, would be the interest less the tax benefit from such interest expenses. And because of that tax benefit, your as a general rule under normal circumstances, your cost of debt would be generally lower than your cost of equity. Okay. So here the answer for number 82 would be delta. You have the cost of your equity as the highest out of all, then followed by your uh, cost of retained earnings, internal financing, and then your WACC and your cost of debt. So your WACC would be in between your cost of equity and your cost of debt, because we've mentioned already that cost of debt would be lower than your cost of equity. And considering that your WACC is the average between your cost of equity and your cost of debt, we can expect that the uh, WACC would be lower than your cost of equity, but still higher than the cost of debt. Again, the cost of debt would be the lowest out of all of them. Now, we have two kind of cost of equity here: the cost of uh, from new issuances and cost of using your retained earnings. So basically, your cost of equity may come in the form of using the income earned by the company or by issuing new shares. Now, why is it the new shares will cost more than uh, using your retained earnings? It's because if you issue new shares, you will have to incur flotation cost, or the cost of the issuances of the shares. So the net proceeds that you would get, the net amount of money, the net financing that you would get from the issuance of shares will not be equal to the uh, price set for your new issuance of shares. Now, for your retained earnings, you might ask, why is there a cost for your retained earnings? Basically, the logic there is that uh, there is an opportunity cost. In your retained earnings, if it is distributed to the shareholders, your shareholders could use the dividends that will be distributed and invest it in some other business. So the part of the shareholders, uh, the activities of the company should be able to produce more return than what the individual shareholders could get if the profits of the company were distributed to them. Okay, so important concepts here: your cost of new issuances will be high due to flotation cost, and there is a cost for the use of your internally generated finances from your income because of opportunity cost. Okay, but going back to the question in number 82, the answer would simply be delta. 83, which of the following statements is most correct? So again, we will need to go over the choices. Letter A, if a company's tax rate increases but the yield to maturity of its non-callable bonds remains the same, the company's marginal cost of that capital used to calculate its weighted average cost of capital will fall. The cost of that. Okay, so this is correct. Okay, if the tax rate will increase, then the cost of debt will go down. If tax rate will go up, cost of debt will go down. Again, in computing for the WACC, your cost of debt should be after tax. Okay, so what do we mean? For example, if the cost of debt is 10% and you have a tax rate of 30%, so your after tax cost of debt would be 10% times 1 minus the tax rate of 30%, or 10% minus, sorry, 10% times 70%, which would give you uh, 7%. Your cost of debt in that example would be 7%. Letter B, all else equal, an increase in company stock price will increase the marginal cost of retained earnings. If the stock price will increase, then the dividend, uh, if you can recall our dividend yield, which is a component of your required rate of return for your equity, your dividend yield is equal to the dividend over the price. So if the dividend over price. So if the price goes up, then your dividend yield would go down. And if dividend yield goes down, all else equal, your required rate of return for your equity would also go down. So it's wrong to say that if the that an increase in the price will also increase the cost of your retained earnings. It's the opposite. Letter C, all else equal, an increase in the company's stock price will increase the marginal cost of issuing new common equity. The same reasoning uh, in computing for your cost of your new equity, you will still be using this DCF, the discounted cash flow model, and you will just transpose or convert the equation so that the cost of equity would be equal to the dividend over the price plus the growth rate. Okay, so if price goes up again, the dividend yield would also uh, go. If price will go up, dividend yield would go down, thereby decreasing the cost of the equity. So that means the only correct statement here is letter A. So the answer for number 83 is letter A. 84, which of the following statements is most correct? Letter A, since the money is readily available, the cost of retained earnings is usually a lot cheaper than the cost of debt financing. This is incorrect. As I have mentioned before, there will be a lot of questions around involving your cost of debt being cheaper. Again, remember, cost of debt under normal circumstances would be the cheapest out of all. So that means letter A is false. B, when calculating the cost of preferred stock, a company needs to adjust for taxes because preferred stock dividends are tax deductible. This is incorrect. There will be no tax benefit for your dividends on the preferred stock. Okay, it's a return of capital. It is not considered as an expense. Okay, so A and B is incorrect. When calculating the cost of debt, a company needs to adjust for taxes because interest payments are tax deductible. Okay, letter C is correct. So that means the answer for number 84 is letter C. 85, which of the following factors in the discounted cash flow model or approach to estimating the cost of common equity is the least difficult to estimate? The answer here, class, would simply be uh, uh, bravo, dividend yield. You just need the dividend and the price. If you recall, in most problems, growth is already given because it's very difficult to estimate, while your required return would depend upon your dividend yield and your growth. So that means if growth is difficult, your required return will also be difficult. The same is true also for your expected rate of return. So out of all of the choices, letter B is the easiest to estimate. 87, sorry, 86. Which of the following statements is most correct? The WACC measures the after-tax cost of capital. That's correct. Letter B, the WACC measures the marginal cost of capital. That is also correct. Letter C, there is no cost associated with using retained earnings. Again, as I've mentioned, there is still a cost in using retained earnings, principally because of your opportunity cost. So the correct answer here would be letter D, statements A and B are correct. 87, which of the following statements about the cost of capital is incorrect? This time we're looking for the incorrect statement. A company's target capital structure affects its weighted average cost of capital. This is correct. It does, because in computing for the weighted average, you multiply the cost of each capital component with their respective weights based on the target capital structure. Letter B, weighted average cost of capital calculation should be based on the after-tax cost of all the individual capital components. This is correct. Again, we're looking for the incorrect statement. Letter C, if a company's tax rate increases, then all else equal, its weighted average cost of capital will increase. Now, if the tax rate will increase, the cost, the WACC will decrease, will go down, because your cost of debt would go down. So letter C is incorrect. Okay, that must also mean that letter D and E are true. flotation costs can increase the weighted average cost of capital. This is true because of flotation cost or cost of issuing your new shares or even for your debt borrowings. Okay. Uh, if you will have to incur flotation cost, it will decrease the net proceeds, the net amount of money that you'll be able to raise, thereby increasing the cost of capital. Letter E, an increase in the risk rate is likely to increase the marginal cost of both debt and equity financing. That is correct. Okay, so again, the answer for number 87 is letter C. 88, Campbell Company is trying to estimate its weighted average cost of capital. Which of the following statements is most correct? Most correct. Letter A, the after-tax cost of debt is generally cheaper than the after-tax cost of preferred stock. That's correct. Letter B, since retained earnings are readily available, is the cost of retained earnings generally lower than the cost of debt? Again, no. Cost of debt is lowest. If the company's beta increases, this will increase the cost of equity financing, even if the company is able to rely on only retained earnings for its equity financing. Yes, because again, our basis there is the opportunity cost, and if your beta increases, then the required rate of return, which will be used as the uh, barometer for your opportunity cost, will also go up. So the answer here must be letter E. A and C are correct. Number 89. Wyden Brothers has no retained earnings. The company uses the CAPM to calculate the cost of equity capital. The company's capital structure consists of common stock, preferred stock, and debt. Which of the following events will reduce the company's WACC? The answer for number 90 would be letter A, a reduction in the market risk premium. All the others will increase your WACC. 91. Sorry, number. Where are we? Why then? And then, which of the following statements is most correct? That was why then. Now, number 90. Which of the following statements is most correct? Need to go over the choices. Letter A, the WACC is a measure of the before tax cost of capital. That's incorrect. Letter B, typically the after tax cost of debt financing exceeds the after tax cost of equity financing. Cost of debt. No, again, lowest or cheapest C, after tax cost of debt. Letter C, the WACC measures the marginal after tax cost of capital. That's correct. So the answer here must be letter C. Number 91. Uh, a company's capital structure that consists of 50% debt and equity, which of the following statements is most correct? Letter A, the cost of equity financing is greater than or equal to the cost of debt financing. This could be true. Letter B, the WACC exceeds the cost of equity financing. No, normally the WACC would be between the cost of equity and the cost of debt. So cost of equity would be higher than WACC. Letter C, the WACC is calculated on a before tax. That's also incorrect. B and C are incorrect. The WACC represents the cost of capital based on historical averages. In that sense, it does not represent the marginal. Okay, again, that is incorrect. Your WACC represents the marginal cost of capital. It's not historical, but more on prospective. Letter E, the cost of retained earnings exceeds the cost of issuing new common stock. Retained earnings would be cheaper than the cost of issuing new common stock because the former will not involve any flotation or issuance cost. So the answer number 91 would be letter A. 92, a firm estimates that its proposed capital budget will force it to issue new common stock. Which of the following steps would mitigate the firm's need to raise new common stock? Uh, Increasing the company's dividend payout ratio for the upcoming year. Uh, if you increase the dividend payout ratio, the amount that you will declare as dividends would go up, so the amount that will remain your retained earnings would go down. So that would, and by the time your retained earnings would be exhausted, you will have to issue new common stock. So a higher dividend payout ratio would increase the need to raise new common stock. So A is correct. Reducing the company's debt ratio for the upcoming year. If you reduce the company's debt ratio, that means you want more capital. So if you want more capital, you need to issue more shares. Letter B is incorrect. Increasing the company's proposed capital budget. No. If you increase the company's proposed capital budget, both the debt and your equity will have to be increased. So if you will have to increase equity, so you will also have to need, that will increase your need to raise new common stock. That means none of the statements above is correct. So the answer for number 93 is uh, echo. Sorry, 92. Number 93, which of the following statements is most correct? What's happening here? An all-equity firm must incorporate beta coefficient of 1.5. The financial manager is evaluating a project with an expected return of 21% before any risk adjustment. The risk-free rate is 10%, and the required rate of return in the market is 16. The project being evaluated riskier than both average project in terms of both beta risk and total risk. Which of the following statements is uh, correct? Letter A, the project should be accepted since its expected return is greater than its required rate of return. Yeah, 21%. That's, you will have to determine its required rate of return. Okay, so the risk-free rate is 10%. The market rate of return is 16. So first, you have to get the market risk premium, which is the difference between the market rate of return and the risk-free rate, which would be 16 minus 10%. The 6% will represent our market risk premium, and what we have to do, multiply the market risk premium by the beta coefficient of 1.5. 6% times 1.5 is equal to uh, 9, and then you add our risk-free rate of 10%. That means our required rate of return is 19%. Okay. So the project should be accepted because the expected return is greater than the required rate of uh, return. Letter A could be correct because it is true that the expected rate of return is greater than the required rate of return. Letter B, the project should be rejected. No, that's opposite to letter A. Letter C, the accept reject decision depends on the risk adjustment policy of the firm. If the firm's policy were to reduce a riskier than average project expected return by 1 percentage point, then the project should be accepted. So if this is the policy, you will have to deduct 1% from 21. That would mean that the expected return now would be 20%, and 20% is still higher than required rate rate of return of 19%. So basically, A and C are correct. Letter D, riskier than average projects should have their expected returns increased to reflect. No, no. If it's riskier, then it will have to be uh, that would be the adjustment should not be to uh, manipulate the expected return. Okay. Projects should be evaluated on the basis of the total risk alone. Thus, if there is so A and C are basically correct in that the returns are greater, the expected return are greater than the required rate of return. It's just that out between A and C, C is the better answer because if a project is riskier than normal, then there has to be an adjustment. Okay, so for letter A, you cannot just make decision without any adjustment, even if you already know that there is additional risk to be considered. So the best answer for number 93 is letter C. 94, a company estimates an average risk project as a WACC of 10%, a below average risk project as a WACC of 8%, and an average risk project as a WACC of 12%. Which of the following independent projects should a company accept? Project A has average risk and a return of 9%. So here what you're going to do is to use the different kinds of WACC depending upon their classification. So since project A is average, you will use the WACC for average projects. And how much is the WACC for average risk projects? It's 10%. And if the return is 9%, it does not pass. It does not overcome the hurdle rate of 10%. So letter A should not be the answer. Project B has below average risk and a return of 8.5. So even though the return is 8.5 only, but these can still pass depending considering that it is below average risk. And based on the given in the problem, if it's below average risk, the acceptable return is only 8%. So that means the hurdle rate is only 8%. So if you have a project that has a return of 8.5%, that means it passes. So project B is acceptable. Project C is above average risk and a return of 11%. Okay, so C is above average, but for above average risk, we need 12%. So even though out of the three projects, Project C has the highest return, Project C will not be accepted because our hurdle rate for above average risk is 12%. So the answer here would be letter B. Number 94 is letter B. 95, which of the following will increase a company's retained earnings breakpoint? Uh, Basically, your retained earnings breakpoint is the amount of capital budget, the maximum amount of capital budget that can be financed, wherein your retained earnings would be enough to finance the equity component or portion of your capital budget. Uh, so for number 95, so obviously, if your net income increases, your retained earnings breakpoint will also increase. An increase in its dividend payout ratio. Uh, no, if you give out more dividends, the lesser amount of retained earnings will be the lesser amount of earnings that will be retained. So thereby decreasing your breakpoint. An increase in the amount of equity in its capital structure. No, if your equity capital structure is composed more of equity, so there would be a lot more that needs to be financed by your equity. Increase in its capital budget. No. The best answer here is letter A, an increase in its net income. Number 96. Which of the following will increase the retained earnings breakpoint? The answer here would be letter B, an increase in the debt ratio. 97. Which of the following statements is most correct? Since debt capital is riskier than equity capital, the cost of debt is always greater than the WACC. No, the cost of debt is lower. Letter B, because of the risk of bankruptcy, the cost of debt capital is always higher. Again, the cost of debt is lower because of the tax break. Letter C, if a company assigns the same cost of capital to all of its projects regardless of the risk, then it follows that the company will generally reject too many safe projects and accept too many risky projects. This would be the answer. The answer for number 97 would be Charlie. Letter D, I want you to read letter D. This is basically the explanation. This supposedly will be the explanation why the cost of retained earnings is generally lower than the cost of new equity, not the cost of debt. Cost of debt again would be the lowest. Okay. Higher flotation costs tend to increase the cost of equity, not reduce. 98. Which of the following statements is most correct? Uh, Higher flotation costs reduce investment investor returns and therefore reduce a company. So it reduces the return. Uh, uh, it will not reduce the return and it will not also reduce the company's WACC. It will increase the cost of equity because the company is getting less amount of financing. Letter B, the WACC represents the historical cost of capital, again, not historical. Letter C, the cost within earnings is zero. Again, you have the opportunity cost. So the answer here would be letter E. None of the statements above is correct. Number 99, which of the following statements is most correct? Uh, in the weighted average cost of capital calculation, we must adjust the cost of preferred stock for the tax exclusion of no tax benefit for preferred stock dividends. Letter B, we ideally would like to use historical measures of the component cost from prior financing in estimating the appropriate weighted average cost of capital. No, we use the target capital structure. Letter C, the cost of the new equity issuance could possibly be lower than the cost of retained earnings if the market risk premium and risk rate decline with substantial amount. No. Your cost of new equity and your cost within earnings are just the same. The only difference is the flotation cost, and because of the flotation cost within earnings would be lower, not the other way around. Which of the following statements is most correct? The cost within earnings is the rate of return stockholders require on a firm's common stock. Okay, yes, that is correct. Uh, no after letter B is incorrect. No after tax for preferred stock. The bond yield plus risk premium approach to estimating a firm's cost of common equity involves adding a subjectively determined risk premium to the market risk-free bond rate. Uh, it is for letter C. Uh, the risk premium is added to the cost of debt, not to the risk-free rate. So again, the correct statement here is only letter A. 101. Uh, Which of the following statements is correct? The cost of capital used to evaluate the project should be the cost of the specific type of financing. No. It should be the weighted average cost of capital. Letter B, the cost of debt used to calculate the weighted average cost of capital is based on an average of the cost of debt already issued. No. Letter C, one problem with the CAPM approach in estimating the cost of equity capital is that if a firm's stockholders are not well diversified, beta may be a poor measure of a true firm's investment risk. That's true. The bond yield risk premium is the most sophisticated and objective method for estimating a firm's cost of equity capital. No. On the contrary, it's the simpler method because you're just recycling your cost of debt. Letter E, the cost of equity capital is generally easier to measure than the cost of debt, which varies daily with interest rates. Or the cost of equity would be more difficult. So the answer here would be letter C. 101 is letter C. 102, which of the following statements is correct? Letter A, although some methods of estimating cost of equity encounters severe difficulties, the CAPM is a simple and reliable model that provides great accuracy and consistency in estimating the cost of equity capital. Uh, I don't think it gives great accuracy and consistency. Letter B, the DCF model is preferred over the other models to estimate the cost of equity because of the ease with which a firm's growth rate is obtained. As mentioned earlier, it's difficult to determine growth rate. Letter C, uh, it's not always accurate, but its advantages are that it is a standardized and objective model. It's not an objective model because of the risk premium that you will have to add. Letter D, depreciation generated funds are an additional source of capital and in fact represents the largest single source of funds for some firms. This would be true. The answer for number 102 would be delta. 103, in applying the CAPM to estimate the cost of equity, which of the following elements is not subject to dispute or controversy? Answer for number 103 is letter E. All of the above are subject to dispute because, again, uh, these are mostly estimates. Which of the following statements is most correct? 104. Answer would be letter A. Beta measures market risk, but the firm's stockholders are not diversified. Beta may not accurately measure standalone risk. That means B, C, and D must be false. 105. Which of the following statements is most correct? The weighted average cost of capital for a given capital budget level is a weighted average of the marginal cost of each relevant capital component that makes up the firm's target capital structure. Letter A is definitely true. Letter B, the weighted average cost of capital is calculated on a before tax basis. That's false. An increase in the risk-free rate is likely to increase the marginal costs of debt and equity financing. Risk-free rate is likely to increase. Yes, both equity, marginal cost of debt and equity. So A and C are correct. So the answer here is letter D. 106, which of the following statements is correct? The WACC should include after-tax components. Therefore, the required rates of return on debt, preferred, and common equity must be adjusted to know only the debt cost of debt will be adjusted. Letter B, the cost of retained earnings is generally higher than the cost of new common stock. That's false. Retained earnings is cheaper than the cost of new common stock. Letter C, preferred stock is riskier to investors than is that? Yes. Therefore, no, that is riskier. Therefore, if someone told you that the market rates for a given company, that person must have made a mistake. Letter D, if a company with a debt ratio of 50% were suddenly exempted from all future income taxes, then all other things held constant, this would cause its WACC to increase. Yes, because that would mean there is nothing to there will be nothing that will decrease your cost of debt. So it will increase the average now. So the answer in 106 is delta. 107, which of the following statements is most correct? An increase in flotation cost incurred in selling new stock will increase the cost of retained earnings. Uh, no, flotation cost is not involved in the cost of retained earnings. Letter B, the WACC should include after-tax components. Uh, uh, this was included in the previous questions already. This is incorrect. Letter C, an increase in a firm's corporate tax rate will increase the firm's cost of debt. No, increase in tax rate will decrease the cost of debt. So that means the answer in 107 is letter E. 108, answer for 108 is letter E. All statements are incorrect. None of the statements above is correct. 109, which of the following statements is correct? Answer is letter B. If a firm has been suffering accounting losses and is expected to continue suffering such losses and therefore its tax rate is zero, it is possible that its after-tax component cost of preferred stock as used to calculate the WACC will be less than its after-tax component cost of debt. Okay, that is if your cost of preferred stock would be lower than the your cost of debt. 110, answer for 110 is letter C. CAM's decision, please go over the question na lang. CAM's decision to not risk adjust means that the company will accept too many projects in the computer business and too few projects in the restaurant business. This will lead to a reduction in the overall value of the company. 111, uh, what is likely to happen over time? The company will take on too many high risk. Answer is letter B. The company will take on too many high risk projects and reject too many low risk projects. I expect these kind of questions to come out in the exam since this will require analysis on your part. 112, if a company uses the same cost of capital for evaluating all projects, which of the following results is likely? 112, answer is if a company uses the same cost of capital for evaluating all projects, which of the following result is most likely? It would accept poor and high risk projects, and it would only be accepting good low risk projects. Answer 412 is letter E. 113, if a typical US company uses the same cost of capital to evaluate all projects, the firm will most likely become riskier over time and its value will decline. Answer 113 is letter A. 114, uh, answer 414 is letter E. All of the statements above are correct. 115, uh, answer for 115 is also letter E. 116, which of the following statements is correct? Answer here is letter A. A relatively risky future cash outflow should be evaluated using a relatively uh, low discount rate. 117. Which of the following statements is most correct? Answer here is letter A. Uh, suppose a firm is losing money and thus is not paying taxes, and that this situation is expected to persist, then the firm's after-tax debt will equal its after-tax cost of debt. Yeah, because again, your benefit will only come from the lower cost of debt is due to the tax benefit. But if there is no tax benefit, then the after tax and the before tax cost of debt will just be the same.